Okay, so let's talk about credit. Okay, guys. And this is like beginners, right? Like basic stuff. Because I realize that every time I build up a new audience, get new people and stuff like that, they haven't watched our, Money Mondays episodes before. So I kind of go through this. And then also we got a lot of people on Myron Gains X that have never seen me do financial content, right? They might have seen me do the minimalism episode a week or two ago, but they've never really seen me talk about credit. So, a refresher. So if you guys, if you guys understand credit very well, you could still possibly learn something here, but regardless. So in the United States, guys, okay, right? And as well as many other Western countries, credit is extremely important, okay? What is credit? Credit is basically think of it as like a score of your trustworthiness, right? Your financial responsibility capabilities, okay? How financially responsible are you? Typically, the higher credit someone has, the more financially responsible they are, right? And the higher your financial responsibility, i.e. credit score, the more opportunities are afforded to you to get money lent to you that can be used to purchase things, right? Now, let me be very clear about this, okay? I know people like Dave Ramsey and others say debt is bad no matter what, right? And I would say if you're a normie, yes, this is true. Debt is bad for the average normie, etc. But if you're watching me right now, more than likely you go against the grain on some things or you're on the path to getting there, okay? People that watch me typically aren't normies. You seek out this type of information, right? When it comes to improving your dating life, how to be attractive, how the world really works, etc. If you're watching my stuff, I already know you're red pill to some degree, right? So that applies even with finances. Now, most Americans are really bad with money. We know this. We know even six-figure earners, a majority of them live paycheck to paycheck. We know a lot of Americans live paycheck to paycheck. We know a lot of Americans wouldn't be able to cover an emergency $500 to $1,000 expense, right? We know a lot of Americans don't have savings, etc. I don't want you guys to be that way, right? But I do think it's important that we understand good debt versus bad debt. Now, for normies, you watch Dave Ramsey, he's going to tell you all debt is bad, which I understand, right? Because when you explain finances to people, you gotta go off the lowest common denominator. And since most Americans are fiscally irresponsible, telling that you can acquire debt in one way, it might mess everything up because they won't understand this. But I give you guys far more credit than that, so I'm going to kind of give the difference here, right? Because I already know just by you guys watching me, you're not normies. So you have consumer debt and then you have real estate debt, okay? When it comes to consumer debt, this is what you would typically assume. Credit card spending, buying things that aren't necessarily assets, right? Running up the credit card for random stuff, movies, experiences, vacations, clothes, cars, like a bunch of BS, right? And then you have real estate debt where you go to a bank, you put down anywhere from 3 to 20% of a home, right? Down payment. Say a house is $100,000. You put somewhere between $3 to $20,000 down, right? 20%. And the bank gives you the other 20 to 97%, 97 to 20%, depending on what type of loan you're getting. If it's your first time buying a house, you can get approved for like a 3 to 5% down payment. If you're a real estate investor, you got to put about 20% down, right? But the bottom line is that the bank is giving you the majority of the money to purchase the home, okay? Now, let me be explicitly clear about this because this is extremely important. Bank of America will give you a loan, right, to buy a home, but they won't give you a loan to buy their stock. Let that sink in. Bank of America, or any bank for that matter, will give you a loan to purchase a home instead of their stock. Why am I telling you this? I'm telling you this because it goes to show the security at which banks feel to lend you money to buy real estate. Because real estate, okay, is a tangible asset that typically holds, but more than likely appreciates in value, right? It's a hard asset. And fortunately, we only have limited space on earth, so you have a finite amount of land, right? Though it is small, that little piece of property that you buy in a grand scheme of things, it is still a part of earth. So therefore, it's solid, if I can break it down in a simple manner. So if you're able to go ahead and get this loan to purchase this home, that should tell you guys that real estate is a very respected and trusted asset class. 95% or so, or over 90% of millionaires make their first million on real estate. And I'll tell you guys, I actually didn't know I was a millionaire until like my real estate guy told me. I'll never forget. I'm just sitting on the phone talking to him about some other stuff. He's like, oh, yo, did you know that the house is worth this much, this house, blah, blah, blah. And you're like, wait, what? And I was like, well, what? He's like, yeah. And then I did the math. I was like, oh, wow. Because your net worth is simply, total money you have minus liabilities. So the houses I had purchased appreciate over time. And then before you know it, boom, you become a millionaire, right? Because your house increases in value, you don't even know. Then you do an appraisal, you figure it out. Oh, wow. Okay. So that house you bought for $100,000 is now worth $200,000. You gain $100,000 in equity. That can increase your net worth and then boom, bring you into the, 1M range. So that's the beauty of real estate. Also, so it's a very good way to hedge against inflation, right? Protect the buying power of your house, because that money that you put into that house, we know that cash is going to lose value thanks to inflation, right? We know somewhere 2 to 3%, maybe even higher if you look at other charts. So you putting that money into that house does a better job of protecting that money's value long term, because the house appreciates, versus if you had just had it in cash, it wouldn't have appreciated. Okay? Now, let me bring this back to what I was talking about before. At the top of this discussion, I told you guys about consumer debt and then real estate debt. The consumer debt, this is the low IQ debt that you want to avoid. This is the Gucci, the Fendi, your car payment, experiences, traveling, all this other crap. This is where most Americans mess up and have a ridiculous amount. Then you have the good debt, which is the real estate. Now, the reason why I wanted to have this episode with you guys, right, and give you guys kind of a refresher on this, is because a lot of Americans don't understand that in order to build wealth, at least in the most efficient and productive manner possible, you don't want to use your money, okay? You want to borrow money to acquire an asset and control the asset with as little money down as you can get away with, okay? It's called leverage. And if you buy a house, right? Let's say you have you buy like a duplex or a triplex. I'm going to keep easy numbers here, guys. I know these numbers would never work in the real world, but I'm keeping it very easy. Let's say you buy a real estate property, right? You get yourself a duplex. You put 3 to 5% down, you live in it for a year, right? Your tenant is giving you, and you live on one side, your tenant lives on the other side. Your tenant is either A, paying the mortgage that you pay every month, let's say it's $1,000, or they're covering a majority of it, or they're covering it so much where you pay your mortgage off and you still have a little bit left over. But the point is that you're living for damn near nothing, right? You live in a house for a year, maybe 2 years, 3 years, whatever you want. Then you move out, give that unit to someone else, charge them $1,000. Now that house generates $2,000 for you. And then you could go ahead and get into another property, like a duplex or a triplex or whatever, put your 3 to 5% down and do that again, right? And you could do this up to, I think, 4 to 5 times with these FHA loans, okay? So before you know it, if you do this correctly, you just leapfrog from house to house, and then you're going to have yourself a nice little portfolio of some homes, right? That'll generate revenue for you. And importantly, not only are you getting the cash flow, you're also getting the appreciation from that house, because every year that passes by, that house is going to go up in value, right? Depending on where you live, it'll go, some areas will scale up higher than others, but that's typically how it goes. So the reason why it's so important to have good credit, guys, is because you need good credit to be able to borrow money to buy assets, okay? Because if you don't have good credit, opportunities just aren't going to come your way. So having good credit, guys, is critical for creating wealth. Now, let me be clear, because I could already see some people are going to be like, oh, well, Myron, I invest in crypto. My credit sucks. Myron, I invest in the stock market, blah, blah, blah. That's cool. That's cool. You can do that. I tell you guys all the time, it's very important to be diversified, right? It's very important to be diversified. However, let's be honest here. The only asset class that's going to pay you money, appreciate over time, and give you enormous tax benefits all in one package is real estate. Sorry. So you can absolutely invest in these other asset classes, but they're not going to come close to the amount of value that real estate's going to give you. And this is why I tell you guys, you need to go ahead and get your credit up as high as possible. Okay. To be able to procure real estate with good interest rates, right? A fair down payment, and slowly start to build up your portfolio, because real estate is by far the most trusted path to building wealth. Has too many benefits: inflation proof, tax benefits, getting cash flow at the same time, appreciation over time. No asset class performs better. Sorry, and consistently. And most importantly, no other asset class can you go ahead and take a loan from the bank and purchase it and use other people's money or OPM. Now, you guys are probably wondering, okay, Myron, this all sounds all good, etc. How do I start? Well, I don't have anything to sell you guys. I'm here to just give you guys some fundamental basics to get yourself in a position where you have a decent credit score and a good credit score, so that you can eventually get your first house, your first real estate property, etc. Okay? So first, what I want you guys to do is to figure out what your credit score is. Okay? There's many different websites and services that allow you to track this. I mean, nowadays, when you get a credit card, almost every credit card has an app that's connected to the card, which will give you the opportunity to look at your FICO score, your Experian, Equifax, etc. Right? So first, we got to get a starting point. What is your credit score? Right? I want every single one of you guys to be aiming for a 750, right? Which will put you very close to or at the excellent range. And the reason for that is because once you get into that range, you're pretty much going to get the most favorable terms for anything you try to purchase or any type of deal you try to strike, right? And getting these better deals over time is going to help you out significantly. Because remember, when you buy a house, you're going to get an interest rate, all right? You want the lowest interest rate you can, because what's going to happen is the more interest you have, the lower your interest, the less money you pay over time, okay? When you look at what's called an amortization scale, right? When you get a 30-year fixed interest rate on a 30-year mortgage for a home, that interest rate stays fixed, but you realize when you look at that 30-year loan, the majority of the interest is paid paid up front. So you really don't start getting into the principal of the house until years later, right? The better your credit, the better you can try to negotiate to get a good interest rate. And that interest rate is going to dictate you paying less money over time, okay? Very important. Also, right, this puts you in a position where you don't have to get predatory loans. A lot of you guys probably know about hard money lenders, right? They give you the money fast, little to no background check or very limited credit check, but the interest rate is ridiculous. It's more used for desperate people. You don't want to be in a situation, guys, where you have to go to these loan sharks to get money, okay? It's a very bad look. And a lot of these loans are pretty much criminal, if I'm going to be honest with y'all, and we know why. But I want you guys to be able to get a conventional fixed interest rate, 30-year, simple home loan and get the best interest rate you possibly can so that you can pay a certain amount over time and not get destroyed as much by amortization, because they always make you pay the interest up front in the beginning of your loan and you don't start paying into the principal until like damn near 10 years later, right? So, and of course we got some people here that think that they're real estate fucking people. That's always funny. I love it when like random brokies try to tell me how to buy real estate. Okay, buddy, get rid of this. Here's Frank, guys. What's up, buddy? He has his little Santa hat. Bro's chilling. So yeah, you want to get your credit score up, okay? So that you could go ahead and get the best interest rate, You're not paying as much over time. Works out for you, more favorable terms, blah, blah, blah. Cool. And then also it makes you more, and then also you can shop rates as well, right? You can shop rates. It puts you in a position of power where you can kind of, negotiate a bit more for a better interest rate because other banks want to work with you because you got a high credit score. Versus when you don't have a good credit score, you have to go to hard money lenders or banks that give you unfavorable terms. You don't want that. You want to be able to get these guys to compete for your business because, like I said before, your credit score is your trustworthiness level. Your trustworthiness level dictates your ability to be financially responsible, pay loans back, and then that will dictate the type of favorable terms that you can get. The higher credit score, the better the terms can be. Boom. Now, once you acquire these, so let's talk about how to get your credit score up. Okay, so for step one, figure out what your credit score is, right? Once you figure that out, right, what your credit score is, you got to come up with a plan. Figure out how much money you owe. Do you have anything in collections? That's actually step one. Make sure you don't have anything in collections, okay? Because one of the fastest ways to absolutely tank your credit score is by allowing anything to get into collections. And a lot of the times, you won't even know sometimes. Let's say you got injured 3-4 years ago and you went to the hospital. You had an ambulance, right? And you just forgot about it. You didn't pay. That could stick on your record and then that can ding you. Or if you've had an eviction, or if you ever filed for bankruptcy, then you're really cooked. But you guys get the idea. Sometimes things will go into collections that you don't even know about, right? You're like, wait, what? I remember it happened one time to me. Literally, guys, I just had to deal with this. So I'm going through my credit score, right? And I noticed it dropped off like 50, 60 points. I was like, wait, what? So I go and I look, and it says that I hadn't paid a mortgage on a house. It was like 30 days past whatever. And I was like, wait, what? I matched up the loan number on the house. I matched up the mortgage number, figured out which house it was. As you guys know, I have like 20 some properties, right? So I have to figure out which one it was. And I was like, wait, what? And I went and I looked, and I was like, wait, I've been paying this thing. What is it? What are these guys talking about? Here's the problem. When I bought the house, I got one lender that was responsible for the loan. That lender sold that loan to another bank. This happens all the time. You'll buy a house, you'll have a loan with a certain bank. That bank will sell that loan basically that loan to another bank, and then they take over collecting the money from you. So what ended up happening was this bank that I had been paying transferred the loan to another lender. So I was able to contact them and kind of, get this thing fixed because I was paying, but it wasn't reporting properly to the credit bureaus. And then bam, my credit score shot up like significantly. Let me see. I'll literally show y'all. I walk it like I talk it, man. Let me pull this up for you guys. I'll hide any info that'll make me look crazy, but, personal info, I mean. Okay, here's my credit score right now, ninjas. So 834, right? Let me show you when I had this number crash. And by the way, guys, the max is 850. So look, you can see it right there, right? 834, right? No cap. You guys can see that right there. It works, whatever, right? Then this is what affects, see that list right there, guys? Payment history, amount of debt, okay. Length of credit history, amount of new credit, and then credit mix, right? So the number one thing here, guys, is payment history, all right? Accounts with late payments for 30 plus days, 0. Because I always pay my stuff on time. Now, what happened was this mortgage company reported that I paid late. That dinged my credit like 50 points. So I contacted them and the other lender and told them, hey, fix this between you guys because I paid you, but the guy that you bought the loan from didn't report that you guys took over the loan. So I basically got a hold of both companies and got them to fix that because there was no late payment because I was paying the other lender that had just purchased the loan from the prior lender. So that's what I did. Got that handled, contacted them, and I was able to get that squared away. But what's the lesson from this? There's a lesson to be had here, guys. The lesson is simply this. You must monitor your credit. If you don't monitor your credit, things can happen. No one is impervious to the BS. And there might be debts that you weren't even aware of that you had, or bills that went into collections that you didn't know that's dragging your credit score down 50, 100, 200, 300 points, okay? And late payments is one of the fastest ways to mess that up, okay? Figure out if you have anything in collections and pay those off first. And you're going to notice your credit score is going to shoot up immediately, okay? So number one, pay off any debt that you might have that's in collections especially, because that's dinging you the hardest. You can call these debt collectors, because typically once a company can't get a hold of you or can't get your money, they sell your debt to another company, another third party. Then that third party, they're contacting you trying to get paid. Every time you get those phone calls like, hey, you got debt, blah, blah, more than likely that debt that they're holding right there, they bought it from another company, okay? And now they're trying to collect because they have the resources to collect. You go to a hospital, you don't pay the hospital ain't going to sit there and try to chase you down for $1,000. They're going to just sell the debt to a debt collector. Debt collector's going to buy the debt from them. Then they're going to go ahead and harass you to get the money. Now, here's the other thing too. If you do have something in collections and you're you want to get your credit score up, you can contact these collectors a lot of the times and offer to get on a payment plan, offer to pay a portion of it, etc., and work with them, and that will help you significantly increase your credit score. You'd be surprised at how much that will help you. Now, assuming you don't have anything in collections, thank God, you want to make sure you're always making on-time payments. As you guys saw with my credit score, right? The number one thing that matters the most is on-time payments, okay? Then you also want to keep your utilization low. What is utilization? Utilization is the amount of the percentage of credit that you're using from what's available to you. So let's say you have $100,000 worth of credit, right? With all your different credit cards, $100,000 worth of credit, right? You don't want to spend, or you don't want to have more than $30,000, right? You don't want to have more than 10%, or sorry, more than 30%. 30% is the absolute max of utilization. So you have $100,000 worth of credit available to you. You don't want to have over 30K sitting there, because what ends up happening is once you get over 30% utilization, what happens is these credit card companies start to they have a very complex algorithm that they use, right, with statistics and everything else like that, and they pretty much have figured out that if you get over 30% credit utilization, there's going to be a higher and higher likelihood that you're going to default and not pay. So what a lot of credit companies, what will happen is this: two things are going to happen. Number one, your credit score is going to drop off a lot once you pass 30%. Number two, some of these credit card companies might turn off your credit card. Every credit card company is different, but if they see that you're starting to utilize a lot, they're going to assume that something's going on and you don't intend to pay this back. And some of them might flat out just like lock your card or not let you make more purchases, despite the fact that you only might be using a percentage. So what I tell you guys is to be safe, keep it 10% or less. Ideally, 1%. I know most people can't do that. That's fine. But at least, guys, try to keep it under 10%. That's really good. I know a lot of you guys might have it at 20, 30, whatever, doable, but never past 30. Never past 30. Once you pass 30, that's when you start getting into dangerous waters. This is when they start, every time you swipe the card, it says, did you just spend this money? They're asking you if there's a fraud alert, a card might decline here, might get declined there, might work over here. Then you start dealing with a whole bunch of BS once you start getting past that 30% utilization, especially if you don't normally spend that kind of money. So be careful with that, guys. Be careful with that. So bare minimum, under 30%. Ideal, under 10%. And then teamwork to make the dream work, 1% or less. That's how you get into, this level here. You get an 834 credit score, and then this is what affects it. Like I said before, number one, look, payment history. Yeah, payment history, amount of debt, length of credit history, amount of new credit, and then credit mix. Like that stuff doesn't matter as much, but the two things that matter the most is payment history and amount of debt. Like right now, I got less than 1%. That's what you guys want, okay? I'm constantly paying my cards, once a week. Now you could wait until the statement comes, but I don't like to let it just accumulate like that. So I just consistently just pay, keeping that balance as low as possible. That's how I do it. Everyone's different. Some people like to take one day of the month, pay all their bills that one day, cool. But me, you have these apps, bro. You can literally just go on your credit card app, every single one of the, whether it's Amex, Capital One, any of these, Chase, whatever, log into the app and then bam, pay and bring that thing down to zero. And you'll notice that your points will go up because typically these FICO and Experian companies run your credit once a week, okay? Now, do you need to have an 800 credit score? No, I'll be honest with y'all. Once you get past like 780, it's a flex. It's just a flex. There's virtually no difference between having like a 780 to like an 815. There's like no difference. There's none. It's just literally vanity points at that point. Okay. So this is why it's so important for you guys to have credit. So let's do a quick little recap here before I answer questions. Number one, the United States of America and most first world countries rely heavily upon credit. What is credit? Credit is basically your trustworthiness, okay? Your credit score is a representation of your trustworthiness to be able to borrow money and pay it back to the institution in time with no delays, okay? The higher your credit score, the more opportunities are available to you, right? Now, in the grand scheme of things, if you really want to build wealth, the easiest and fastest way to do it typically is via real estate because of the benefits of cash flow, tax benefits, hedging against inflation because it goes up in value, so many different benefits. And the way to procure real estate optimally is by leveraging loans, using leverage, where you put a percentage of money down, you acquire the asset, you control the asset with only using a portion of your money, and the bank gives you the rest. The bank giving you that loan, aka on leverage or whatever, is based upon, or the terms of you getting that loan is based upon your credit score. So this is why having your credit score is extremely important. Having a good credit score is extremely important for your ability to build wealth, because we know the number one builder of wealth that makes the most millionaires is real estate. And your ability to purchase real estate and control real estate is heavily contingent upon your ability to have a good credit score, unless you're buying houses cash, which I don't suggest you do that. Okay. It's not really if you want to be optimal, buying houses cash is not the best way to go. Obviously there's situations and, scenarios where it could make sense to buy a house cash, but in most situations, it's probably not going to benefit you in the long term buying a house cash. But that's a whole other conversation, right? Then the way to get your credit score up quickly is by, number one, making on-time payments. Then number two, keep your utilization low. Under 30% total, under 10% optimal, and then under 1% if you're a real G, okay? And this can be done paying, your credit cards every couple of days, every week, whatever. Everyone's different how they do it. Me personally, since I have different business credit cards or whatever, I'm paying that thing off maybe once a week, knocking it down. And then also another benefit besides the real estate, which I didn't get to tell you guys, is the better your credit, the better credit cards you can get, okay? This is another reason too why I heavily suggest none of you ever use cash. Using cash to purchase things, you stupid, is probably one of the most ridiculous and low IQ things you can ever do. Why? Because you are spending money that you otherwise would have been spending regardless, and you're not getting a benefit for it. Let's say I want to buy, a TV, right? Two scenarios. Scenario one. I go in there and I buy the TV, cash. All right, cool, whatever. Scenario two, I go in there and I use a credit card, right? TV breaks in 2 weeks. Well, if I don't have a warranty or anything, I'm cooked. TV breaks in the second scenario, well, I have a credit card that, has insurance for electronics bought. Maybe it's one of the perks of the credit card, right? I can go ahead and get that thing replaced because I purchased it with a certain credit card, or I do some type of claim. Or I get points. I get a cash back, right? I got a 2% cash back credit card where everything that I purchase, I'm getting 2% on that, right? And then over a period of time, when you use a cashback credit card, you just earn hundreds, if not thousands of dollars over time for money that you also were already going to spend. So at bare minimum, guys, let's assume you don't want to buy real estate. I don't want to do that, Myron. I just want to focus on, cryptocurrency. I want to focus on the stock market. Cool. No problem. But at least get good credit so that you can go ahead and keep opportunities open for yourself, and so that you can go ahead and utilize credit cards that actually give you benefits back. Guys, buying for things in cash or with a debit card quite literally is throwing money outside. It's throwing it out the window, because you can use a credit card, which is going to reward you for spending that money that you otherwise would have spent, and you get a bunch of points. Guys, I'm going to show you guys my Amex thing real quick. Give me 1 second, ninjas. Y'all see that? 1.5 million points? 1.5 million points on Amex just from buying things that I otherwise would have already bought. I could go do a world tour right now for free pretty much, right? I want to take a random vacation. I want to go to, Tulum. I can literally do that right now for free. This is why I tell you guys, get your credit on point. Once you get your credit on point and you show that you're a trustworthy borrower, you get to get better credit cards. Better credit cards give you better perks. Use those perks when you want. It's free money. It's literally free money, okay? You guys tell me all the time, Myron, why are you a minimalist? Why do you not spend money? That's why. Keep my credit score high, got a bunch of benefits. I could travel whenever I want, whatever, even though I'm not going nowhere. But it's good to have. It's good to have, right? You can use your points to travel instead of spending your own money. So this is the benefit, guys, when you have good credit and then you utilize credit cards that give you something back in exchange. And here's the thing, guys, you don't got to get an Amex Platinum or whatever. I have an Amex Platinum Gold, whatever. Bro, for you guys here that are kind of new to this, just get yourself a good cashback credit card. That's it. Honestly, I tell everyone at least, please, if you guys are going to do one thing, right? I have two requests. Number one, don't pay for things with cash or a debit card. Please don't do that. Okay. Don't do that. That's number one. Number two, get yourself a cashback credit card that gets you somewhere between 1.5 to 2% cashback on all categories. Okay. If you could do that, you literally just use that card for everything, and you just run it up and just pay it off. Run it up, pay it off. Run it up, pay it off. You do this for a month, you do this for a year, you do this for years. Now we're talking about thousands of dollars that you're making for simply swiping a card for purchases you would have done anyway. So at least, guys, get a cashback credit card. Now, if you like to travel, you go ahead and get yourself a travel credit card. And none of these guys are paying me to tell y'all this. I'm just telling you guys, from my experience of what I do, and I just want to help you guys out. But get yourself first a good cashback credit card. Once you get a good cashback credit card, then you can diversify, go ahead and get yourself a good travel credit card. Then if you start a business, go ahead and get yourself a business credit card. But that's